In another key policy move, the Nigerian government, through its apex banks, the Central Bank of Nigeria, has asked commercial banks in the country to trade Forex at any rate. This move is a deviation from the previous parallel rate that Nigerians have long complained about. The new policy, although yet to be officially announced, had been suggested by President Bola Ahmed Tinubu on his inauguration when he talked about having a single Forex rate across board. Again, questions have been raised on the implication of the policy and how it will benefit the generality of the population. Joining me tonight on Politics HQ is a researcher and economic analyst to unpack this new policy. I have the pleasure of speaking with Basil Abia, research associate at Kwakol Research. Joins us live from Nigeria's Federal Capital Territory, Abuja. A warm welcome to you, Basil, and thanks for joining us on PHQ tonight.
Thank you very much, Gbenga, and hi everyone watching from their respective homes, of course.
Now, Basil, let's get straight to the business of the day. Quite shocking to some and, not so surprising to others. Can you explain the implications of the Central Bank of Nigeria's decision to grant commercial banks the freedom to trade foreign exchange at any rate? What are the implications of this directive?
Okay, yeah, thank you very much. First, this is a significant policy shift from the immediate past for foreign exchange controls that were very strict and stringent in the sense did not allow for markets participation, pegged it at a particular rate, allowing for a lot of arbitrage, and there was also a utility for the black market in that sense. Now, what this policy shift does is that banks will now be able to trade foreign exchange at the market rate. And this basically is a demand and supply mechanism that will be used for foreign exchange trading. So that means that arbitrage is going to obviously be eroded. I'm not saying that this will completely no longer be the case, but it will be eroded. And we're going to start to see that shift. Also,
when you say it will be eroded, it means there's bad news for the black market, the Bureau of Change black market operators.
Yes, but not now. It takes a while. It takes roughly 12 to 18 months for us to see the full transmission mechanism. In economics, when you set out a couple of policies, it takes a while for that transmission to happen, and then we now see the full effect in the macro economy, the larger economy. So in the context of these particular policy decision, it's going to take a while, and that would mean that people will be able to readily access foreign exchange from the banks. And when they're able to do that, we now see the black markets rendered useless, and that obviously now allows us to experience a unified exchange rate. So for now, obviously, the exchange rate is now a freely floating rate, and that means that folks can put in as much money as possible, as much FX as possible in the markets, especially in the capital markets, and they can also repatriate whatever their return on investments are. So there's ease in that sense, and that exchange makes the markets very attractive to international foreign portfolio investors. So already we have started to see a
jump,
immediate impact. Just got data right now through Nairametrics, and they're reporting that the Nigeria Exchange Limited, or Nigeria's, yeah, of course, the NGX traded gained 992 billion naira on its market capitalization, obviously, and the bank equities are actually doing very, very well. In fact, the top 3 traded equities are all bank equities. So the markets are reacting to a very positive policy decision. I think, not that I think, the data is also reporting that UBA PLC is the most traded equity for today at the NGX. So we're seeing the markets
moves on that front. But Basil, how does this move towards freely floating exchange rates align with President Bola Ahmed Tinubu's promise to unify the multiple exchange rates in the market?
Technically, this is the right way to unify the rates. As I explained, the transmission lag will take 12 to 18 months. In fact, I was talking to my colleagues one a development economist and another a monetary economist. The monetary economist is Chimere Ehionu, and the development economist is Joseph Ishako, and also another colleague of mine, Victor Igono. And we're predicting the transmission lag to be complete by the 14th month after this decision has been made. So, and the reason for that is that a lot of things will have to be factored in. How is the international, how are the international markets reacting to this news over the long period or over this medium-term period? Would we have significant FPI inflow? Would people, and what I mean by FPI is basically foreign portfolio investors, investors who are interested in Nigerian securities, be it debt, be it bonds, be it, of course, stocks, or even, commercial papers in that sense. So if you have an average, or if you have hedge funds in London, in Singapore, in New York, saying that, okay, this is good, this is really attractive, I can put in money and get money out as fast as possible, that draws in as much FX inflow as possible. And because of the demand and supply mechanism that determines how the foreign exchange market works for a freely floating exchange rate, we're going to see the necessary FX inflow to meet our very significantly high FX demand. And when that does, is also a convergence of the rates. That can also take 10 to 12 months. So that convergence of the rate is, we saw something similar I would say very early, right after the decision was made. When the decision was announced, around 1 p.m., I called the black market dealer that is I would say an acquaintance of mine, and I asked for the market rates, and he said it was 757 naira per dollar buying and 755 naira per dollar to sell. And then I also saw that in the investors and exporters FX window, the central bank was selling for around 750 naira. Obviously,
so quite close. Now, Basil, ordinary Nigerians are wondering, okay, this policy has been, the federal government has started this policy. Are there potential benefits and risk associated with operating a freely floating exchange rate in Nigeria?
I will start with the bad news. I think it's good to end with the good news, so I'll start with the bad news for Nigerians. Unfortunately, things are going to get harder for everyday Nigerians. And the reason for this is because we have already removed subsidy. That means obviously that we've seen a surge in PMS, the price of PMS generally. We did the math last week, and in the article that we released, we calculated that the national average, the increase in PMS, petroleum motor spirit, or fuel, as we colloquially call it as Nigerians, increased by over 193%. Now, there's that transmission that happens to the price of food and services. Obviously, as we know, anytime fuel prices increase, prices of other services increase. So that transmission could take close to 150% higher. So if food is going to be just around that amount. Now, that is already contributing to our very high inflation rate. We will have a 22.22% inflation rate. Food inflation is at 24%. So when you now add another 193% increase in fuel prices, maybe around 150% increase in food commodity prices, then you now add the fact that the naira is now devalued as a consequence of the freely floated exchange rate. The situation is that because we don't have enough FX inflow for the meantime, and then we now have the OPEC putting a cap on our production output at 1.3 million barrels per day, when we can't even reach that amount. We're currently doing 1.13 million barrels per day. So if you add all of this together collectively, it means the inflation rate will surge higher. In fact, I am predicting that inflation rate will hit just around 30%. Now, conservatively, this could be less. This could be lower. It could be around 25% by December, by the end of Q4.
But there's
if things are really, really bad, it could be 30%.
Now, well, let's move on from the bad news to the good news. Now, what's the good news?
Can I just add some color to the bad news? Sorry.
Wow, color to
now
bad
for
news.
The average. Yeah, for the, I mean, it doesn't make any sense, color to the bad news. But what I'm trying to say is that with higher inflation, the purchasing power of the average Nigerian further erodes, it further reduces. So things get harder, and with that, life is harder. We're going to see a solid surge in just how tough life is for Nigerians. Price of food would increase, price of transportation, of course, would increase, price of services would increase. That means that Nigerians would act like the rational beings that they are. That's what basic economics teaches us. What that means is that they will only spend on essentials. They will no longer want to spend on drinking beer, for instance. They will no longer want to spend on tobacco, for instance. They will no longer want to go to the clubs, for instance. Their offerings at their respective churches would reduce. That spending limit transmits to the producers. So you now start to see middlemen reporting back to the producers that, look, my inventory stock, I'm going to have to reduce it by 20, 30%. This transmits to the producers, and the producers start to reduce their production. So we see a reduction in productivity nationwide.
So
on a
what's
national
the
scale,
positive part? Because I want us to unpack as much as possible in the little time we have on the program tonight. So what's the positive aspects to us floating the Naira?
So the positive part, we're already seeing that impact. The capital markets are reacting very, very well to it, as I said, and they've been reacting to
but what's the reaction of the capital market to the common man on the street? He wouldn't understand. How do you break it down to see that, look, in the long run, I will gain from this policy by the government?
In the long run, we're able to get investors, non-Nigerians, to put in their money and basically defend the fact that they trust this particular company to do well. Now, with that reposition of confidence from the international investors, these companies use the money, of course, to increase productivity. So in the long run, outside of the short-term and medium-term analysis that I've given, our economy would receive far more foreign exchange than it currently has, which will make the economy productive, which will increase jobs, which will transmit to higher wages, which will obviously give us a very good life. Now, one better way to look at that is even from the FDI perspective. Now, foreign direct investment is distinctively different from foreign portfolio investment. Foreign portfolio investment, you just basically invest in a number of instruments in a country's capital market. But foreign direct investment is when you ship in your own money to set up a company. And when you set up the company or the business or the operation or the special purpose vehicle, you're going to bring in money into the market. Obviously, you're going to employ folks. When you employ folks, they're going to get earning, and when they get to the earning, they take care of their households. Now, I'll give you two numbers and to show you how important this is. First and foremost, average household rate for Nigeria is 5. So every household has at least, or averagely, 5 people, right? Now, imagine one particular earner getting a better job due to this FDI flowing in. It means more earnings to the remaining 4 mouths. That obviously brings more money to the market. So I like to think of the economy from a macro perspective, using what I call the bidirectional causality. So one positive inflow causes more positive inflow, and it continues. So there's a circular manner in that sense. So with more FDI and more FPI, things get better generally in the long run. Our economy is buoyant. It's attractive, and we start to see investments in infrastructure. We start to see jobs. We start to see the numbers get higher. But I don't want to get the hopes of Nigerians high. So I'm going to say, please temper the excitement with a lot of watch, because the next 12 months will be very, very hard. And another thing, if the Tinubu presidency doesn't follow through with removing foreign exchange restrictions on food imports, it's even going to be tougher to be able to see a stabilization in the market. And what do I mean by that? Currently, we have very high food inflation because most of our food commodities are imported. We don't have enough domestic supply to meet our high domestic demand, so we import all of these food commodities. Now, because of the FX, the death in FX inflow, it's going to be harder to get the necessary foreign exchange to be able to access. I mean, it's going to be easier now, but it's going to be more expensive. And that will transmit to the price of food that we're paying for. So one way to make things easier for food importers and for the food prices to stabilize is to ensure there are no longer FX restrictions on food importations. And then all the food importation bans, rice, wheat, all of those sole importation licenses that were accorded to some popular oligopolies, please relax it.
Okay.
Ensure that it's no longer restrictive, so
Now, Basil, just before
in
we
medium
begin
term,
to...
we can manage the food inflation.
Okay. Just before we begin to wrap this up on tonight's discussion, in what ways has this significant discrepancy between the official exchange rate and the parallel market exchange rate affected the Nigerian economy?
In a lot of ways. First part, of course, is that it has contributed to a lot of hoarding. So obviously, with the foreign exchange scarcity that we've been enduring for the last 4 or 5 years, a part of that transmission mechanism is that people, some people at the top echelons of society have access to huge volumes of dollar given by the CBN to them, at a very friendly rate, say 430 or 415 naira per dollar. And what they do is basically hoard till, of course, they see a very good position in the black market to sell. So that round tripping, that arbitrage has been, a mechanism for that 1%, that elite 1%, to be able to make as much illicit money as possible. And that has starved the real economy from the needed foreign exchange that it needs. So we are going to see that reduce drastically. We hope that that happens as fast as possible so that we can stop all of these illicit trades. And, just because the economy needs as much foreign exchange as possible. And that's the number one thing. Okay. The second part, of course, is that it undermines our capital markets so badly. It undermines it. And we want a capital market that is buoyant, that is attractive, that functions based on the principles of the free market economics. And unfortunately, we have not seen that yet. So I think with this particular policy shift, we could see that happen. I would just add that the all-share index for the NGX was the 4th best performing stock market in the world, according to an MSCI all-country index that basically tracks over 48 stock markets around the world. So this will boost our capital markets.
Thank you very much, Basil. And I believe that if the government follows through this policy effectively, Nigerians will be better off in the long run. Thank you very much, Basil Abia. Always a pleasure speaking with you, research associate at Kwakol Research in Abuja. It's now time for me to...